After a groundbreaking year in infrastructure investment, with fundraising goals smashing previous ceilings, it's fair to say that expectations in the asset class are climbing. There's little doubt that opportunities continue to flourish in infrastructure across GIA's core markets. But where do risks lie, politically and market-wise? And what should investors be on the lookout for in the next year, according to the experts? Welcome to Talking Global Infrastructure. I'm John Phillips, the Chief Executive of the Global Infrastructure Investor Association. On our first podcast of the year, we're bringing you fascinating insights from incredibly knowledgeable members of ours. Darryl Murphy, Head of Infrastructure at Aviva Investors. And we're also joined with a guest appearance from one of our media partners, the Deputy Editor of P3 Bulletin, Jonathan Davis.
Well, joining me today is Darryl Murphy, Head of Infrastructure from Aviva Investors. Darryl, hi, great to see you.
Hi, thanks, John.
Thanks for your time.
Thanks for having me.
Can you kick us off by talking about Aviva's approach to investing in infrastructure? Which markets, which sectors, what risk profile are you pursuing?
Yeah, thanks, John. Thanks for having me. I lead across infrastructure in Aviva Investors. We have debt and equity strategies. We've been investing in debt, many people will be aware, for many, many years, actually. And I think classically would have been seen as down the fairway institutional debt providers. We're very focused on UK and Europe, classically longer duration, generally investment grade at volume. More recently, we've expanded our repertoire. So now we have debt, which is high yielding, which probably lines better for some of our pension fund clients. So that's given us more breadth. And then we have an equity strategy, which our current fund is very focused around growth. And we've made investments into UK fiber, UK EV charging. Our latest investment there was a German battery storage platform. So again, it's growth, typically at the platform level where we're trying to look at growth of those underlying assets.
So when you're weighing up the opportunity to deploy capital across Europe as your domain, how did the UK measure up in 2025 in that context?
Well, indeed, I think the data I've seen recently in 25 was slightly surprising, which is all in, it would suggest that UK and Europe went through a sort of record year in terms of investment. Is it surprising? It's only surprising because it doesn't always feel that way on the ground. Maybe the sourcing of data is better, so it's hard to compare over a long period of time. But also to take into account for us, we are a UK institution. We are much more bound to, obviously, natural sterling. A lot of our internal capital is sterling. So we're much more focused around the UK as a natural home, but equally across Europe. I think the benefit of Europe, of course, is diversification. I'll be the first one to say that I don't see any country across Europe leaping above one or other. What you've got, of course, is an opportunity to scan across and look at different markets. So, for example, when we looked at battery storage, it's not, and I'm not going to pretend it was incredibly insightful to say battery storage is a good investment. There are a lot of people in that area. The key was particularly what country to look at that in.
Yeah.
UK is quite developed on battery storage. We were seeing Europe slightly behind, and we're not alone in thinking that Germany was in a good position to actually generate more value. But we did quite an extensive process just to look at, once you identify a sector, what geography might align to it. If we look at UK, though, there is no doubt that, to say, we're domiciled here, we've got natural sterling capital, it is the home. I think you also have to recognise that private sector ownership of assets in the UK is well established. We arguably, the data would show that of the whole of Europe, including UK, use an old-fashioned sort of definition, the UK would form about 30% of the European market. So there's no doubt it's the largest market consistently by a long way. So I think even for an international investor coming in, you really have to look at the UK in that context. Why is that? Of course, as we note, it's because historically we've got wholesale privatization many years ago, privately held assets, and generally a support for further private capital into the UK. The challenge is this point around, so why did the market look so great? I think the reality was large elephants, you might call it. if you look at the big deals that we saw, I mean, UK is dominated to some degree by Sizewell, which is a little misleading, of course, because the vast majority of that capital is from governments. We saw deals like HARP, which obviously a DPC, a water project, which, you know, reasonably large.
That's the reservoir.
Yeah, that's the water, it's the aqueduct.
Right.
So transferring water from effectively from the Lake District down to Manchester in terms of supply.
Yeah.
And that's a interesting model being developed over many years. Large transactions get over the line. You've had, I guess, the second CCUS transport deal, HyNet, closing 2025. The first one obviously in 24. So you get these very large projects. I think if I look in my lifetime, in the old days, it used to be quite rare to get a £1 billion transaction. They're not so uncommon now. You've probably got at least, particularly corporately or projects, a reasonable number, maybe 10, 15 per annum. And that's what's driving the market.
So the total deal value is actually somewhat obscured by the fact that it's a small number of big projects.
Absolutely, yeah. So I think that's probably giving a rosier side.
Yeah.
But I think overall, there is no doubt there's this sort of signs of picking up of, we want that investment to come. The government's driving it hard. I think the opportunities are there, but I think the bigger point is there still feels there's a lot more to come.
Yeah.
So sometimes it can feel that my analogy is we're sort of in the, sort of not quite now at the floor of the Grand Canyon looking up and going, well, all this is, it may feel a bit jammed tomorrow in that sense, but that investment is going to come at some stage.
Right. When I talk to a lot of our members, I feel that to a large extent, the interest in the UK is dominated by brownfield investment. It's trading stakes in existing assets, as opposed to there being a really strong pipeline of greenfield opportunity. Would you agree with that?
I think over the last 2 years, it would be absolutely the case. And I think it's understandable for, as we just said, we've got this long history of privately owned companies, very mature. I think equally, a lot of investors increasingly want scale. So if you take the UK market, if you take the fact you've got private ownership in vast array of utilities, water, transmission, distribution, etc., all of energy generation generally being privately financed, airports, ports, etc. So you've got this strong ownership level. And certainly we see this on the debt side, where until, the last 2 years, M&A refinancing was driving a large part of our debt activity. And where is that coming from? It's not necessarily appetite for new assets. It's that trading of assets, funds wanting to build up an asset, sell, secondary stakes grow.
I think there's one particular area I think would be good to get your thoughts on about what the thinking is around the reemergence of a PPP model in the UK, and which sectors and what kind of what kind of changes to that model do you think we're going to need to see in order to sort of make it work in today's somewhat more kind of politically charged environment?
Absolutely. I think we should start at the 10-year infrastructure strategy, which, again, to give a lot of credit to government, I think there's nothing wrong at all having a strategy in a sense. We'll come to the fact that, in a sense, we've got a guiding light where we're going. It's a question now about delivery, but there is this much awaited sense of, was PPP coming back? I will say, I think a lot of my peers in the market have probably got a little bit carried away with this whole idea that somehow we're going back to PFI, if you call it PFI in that context. I think our thinking has moved to PPP needs to probably go through a change in definition. It's not really, as we tend to use it, kind of interreplaceable with PFI.
Yeah.
So PPP in a broader context about the public and private working together.
Yeah. More a kind of a JV type.
Exactly. I mean, it could, not be wedded to exactly what form that takes.
Yeah.
If we look at actually what the infrastructure strategy says, it's quite interesting insofar as it's positive, nodding in the direction of what they call user revenue opportunities. And the two most prominent are Euston Station. So it's a infrastructure regen type opportunity. Probably better known would be more around Lower Thames Crossing, which again is unusual in the UK because actually we have generally crossings which have toll revenue. So therefore, I think the message from government is we're willing to have more private type models where there's user revenue. So the common phraseology that everyone will refer to is the difference between tax-funded and user-funded infrastructure. And historically, tax-funded infrastructure like schools, hospitals, etc., we use the PPP model. Now, the strategy was pretty clear, which I do think some people kind of just decided not to read too closely, which is it nods in the direction of the neighborhood health centers, which are being developed. We've invested in NHS lift schemes many, many years ago. We've had a long history in that, been very successful. We've been engaging around that, and we think that will be a good way to develop, much needed local healthcare. But that's quite a narrow application. There's also reference to public estate decarbonisation, which is a broader challenge. Beyond that, the government's message is still very reticent around the use of PPP for tax-funded infra. The alternative is, of course, where there's user flows. I think my observation of that means that apart from those two cases we spoke about, most user-funded infrastructure already has ready-made models in a sense, i.e. we talked about energy generation, the use of the CFD. We're seeing that slightly different adaptation in terms of cap and floor for interconnectors or for long duration storage. So we've developed different models for user-funded infra. So then the bigger challenge is, well, are we comfortable that the tax-funded infra effectively is going to be delivered through, for the most part, public borrowing? And that's the message. And that's the message we've had for a number of years, which is focus on energy, utilities, private transport, digital. You can probably focus on social infrastructure, meaning particularly schools and hospitals, and public transport for the main part will be publicly funded. Now that's, I think, a delicate balance, particularly in these fiscal times, whether that is the right model. In a way, I think the challenge to everyone is, can we start to think a little bit more broadly outside of that PPP model to say, what is the role in that private sector delivery model? There's no doubt the key remains the fundamental points about what is that revenue stream? Is that coming directly from a local authority, mayoral authority, or is there any form of other capital? And, what you're seeing from government is interest in things like whether that's land user charges, whether it be housing, etc. These are quite tricky models, a long way from where we've been used to, which is a very simple government revenue stream, PPP.
Yeah, I get that. But I think one of the, my observation and when I get the opportunity to talk with government, I always kind of land this is that with the way the public finances are right now, this is not a conversation about whether or not it should be publicly funded or privately funded. There's always a cost for not building infrastructure, as well as there is a cost for actually having infrastructure.
You're advocating, many years ago, doing a lot of PFI, PPP, people say, it's just mortgaging assets. And I think these days, a bit older and wiser, I go, there's actually nothing wrong with that. There's a reason why we buy our houses on a mortgage basis, because we can't afford it day one. So I think the only thing, to be fair though, is what we have to get right is that concept of risk transfer.
Yeah.
And it's about the evolution and learning about how you create a better model. To be fair, I think we've not really had the chance to probably put that into practice, other than we've seen, green shoots. And it's interesting, you look across the UK, the MIM model in Wales, which I don't think is a secret to say is only a sort of a sibling effectively of the PPP,
the mutual investment
model, which is very similar to PPP construct. We were involved in that in terms of the schools program, obviously Velindre Hospital, road. We're now seeing Scotland announcing that they're going to adapt that model as well. So we've seen a success in certain areas. The key bit is, can the private sector learn from the past? But there's one point I do feel passionate about, which is you look at the MIM model as adapted, it does have rather more contractual linkage to community benefit. So I think these are the little changes that can actually just change that perception.
And so new adaptations to that model that maybe give communities a bit more stake in the success. With a firm eye to the future, I think two sectors that have not been typically linked to the infrastructure asset class in a core kind of way. Housing and defence, both of those sectors are now being talked about really quite regularly as being a potential infrastructure investor play. What are your thoughts on both of those?
Yeah, I think this is a good segue in terms of this challenge to investors who were saying the market has moved. We've talked a lot historically about, the infrastructure the last 20 years will not be the same, but we have to evolve. And it's not just the new things in energy transition. It's also perhaps how we use some of the infrastructure technologies, if you want to call it that, in sectors like housing. The government has deliberately, through the infrastructure strategy, expanded into social infrastructure, of which housing is a very big part of that, in particular, affordable housing, social housing, for the communities. So some of those models are well tried and tested. There's been a lot of private capital. We invest on our real estate side in terms of single living housing, other sort of schemes on a more private scale. I think the challenge is that segue. There's thoughts around, the National Housing Bank developing, and again, you've got a lot of the banking market provide a lot of the mortgage supply. So you've got a lot of attention now focused in on this sector. If we look at housing, we've seen that the government's announced the new towns. What's interesting on this is, just as an example, they don't really, housing doesn't sit anywhere without core infrastructure. So if you think about any reasonable sized development, you need roads, possibly rail, you certainly need services, social infrastructure, schools, health centers, etc. So this becomes a sort of much broader planning challenge at a sort of master planning level. And I think one of the things here is, and what challenge of government is, how can the private sector really lean into this? Not just, therefore, classically private house builders building houses.
Yeah.
How do we actually create, to some degree, communities which need infrastructure and housing? And also a more place-focused kind of strategy, segue of how do you want your transport regime to sit alongside housing? Because generally speaking, in cities, you either live downtown, as it were, if you're in the US, and actually your transport adapts to that. Or if you want to have major cities and actually have people living on the outskirts, you've got to get them into the city. Otherwise, the whole reason to have productivity and growth won't happen. So I think the challenge is these models are not cookie cutter. And I think that's the challenge for investors. And I think whether it be from the real estate side, the housing side, but we have a lot of capability in infrastructure space to say, well, how do we change this model? And I'm not saying here and now there's a simple answer, but I think it's challenging people to say, do we need to look at things in a different way?
And then defence.
So again, I think defence is interesting. The MOD, of course, is, so in my experience, very sophisticated client in terms of the way it's structured and has a number of different commercial models. It used PPP for support services, and it pushed its limit. It has obviously the air-to-air refueling aircraft, tank transporters, even to that level of embracing sponsored reserves, which was, if you go back in time, was quite something, right? Actually having a contractual model where your asset could actually go into combat. Obviously, a lot of it, though, is fundamentally about training support services. Policy-wise, MOD moved on with its capital. We now face this sort of vast investment. And it feels, again, that, and there's a lot of talk around, there needs to be more private investment into the defence sector in different shapes and sizes. And I do feel that, we could go back, in theory, to looking at some models where, again, we're back to this, what does this PPP JV thing look like? Particularly for the most obvious is back to those support services, building training facilities. Maybe it's in and around, and I know the National Wealth Fund has referred to opportunities where there's a civil military crossover. So drone production might be an example, I guess. So I do think there's potential usage there. I think, everyone will leap ahead and say it's not about financing the upfront weapons. Actually, there's a lot of support services needed where I think the private sector can offer a lot of capability.
Darryl, thank you. We've covered a lot of ground. That's been really interesting for me, and I hope our listeners too.
Today we're going to be looking forward to 2026 and particularly in the US market. And with me is Jonathan Davis, Deputy Editor of P3 Bulletin. P3 Bulletin is a publication that provides market intelligence to public and private sector leaders who come together to deliver public-private partnerships, or P3s as they're known in North America, and which we partner on various projects. Jonathan, thanks for joining us. Really good to see you.
My pleasure to be here and to represent P3 Bulletin. It's been an exciting year, and this year's going to be even more exciting, I think.
We worked together last year on a series of roundtables looking at the state of the US P3 market across various sectors. We looked at energy, we looked at roads, digital, airports, and water. So I thought it would be really good a way of starting our conversation up, I guess, to just ask you to share with us, what you took from those conversations in overall terms. As you reflect on the conversations, what did you take from that in terms of the state of the P3 market?
Well, I think the conversations themselves were emblematic of the P3 market. You had a really, really frank, open discussion, both across public and private. We had some really high-level public people there, and we had all different angles of the private sector, whether you're an investor, contractor, advisor. And there was a real yearning to have these solid, frank conversations, because you've got, in these different sectors, as you said, energy, roads, airports, water and digital, a real mismatch of some have the wind in their sails and some are still trying to figure out how to go to the next step. So for instance, you have in the road sector, which a decade ago you thought it was at its peak. It's spent a few years, a bit nascent, and now it's come booming back with some really huge deals and a really exciting pipeline. The best there's ever been in that industry. There's even questions around capacity in terms of the investment and the pool of players in the market. That kind of problem is unthinkable in a few years ago. Similarly, in airports, what you have is the big breakthrough projects like JFK and LaGuardia have opened up, the field for other projects to come in their wake, and so that's really exciting. And then you've got these new sectors like energy and digital, where P3s are still figuring out quite where they fit into that, whether that is in terms of taking technologies off of the public sector hands, taking those risks and delivering them, or whether it is perhaps, trying to scale up the type of things like, say, EV charging. There's been pilot projects in those areas. Some have worked, some haven't worked. So lots of problem solving in those sectors. And then you have water, which faces different sets of challenges, but has some really exciting kind of landmark projects in the works to try and set the tone to open up the next one. So you've got a real clear range there of two sectors have got those test cases in, they've proven their worth, and P3s can add real value, and the public sector see that. Another where it's getting there in water, and then two more where there's still problem solving going ahead.
So I'm really interested to hear what you say about roads. So what do you think what has the catalyst been for that resurgence in road P3 opportunity?
There's a few. The first one, as I said, is that the test case has really borne out to be true. If you look at some of the Build America Bureau's data, they say that the revenue risk models and some of the really high profile projects, almost all of them actually, have exceeded the expectations of what they were projected to do. You also have new types of projects, most notably managed lanes, which is where many of the US citizens would know this, but you have an extra lane being added to an already existing highway that enables drivers to take a choice of whether they want to go down the fast lane or stay in the ordinary one. And doing that, having that choice element to it, has really helped with the political angle of things, and not having just big tolls, because tolling can be difficult in many communities. So that has really helped push the market forward. But most fundamentally... because managed lanes give users a choice, not because they're put into a sort of a no-choice scenario of tolling or nothing. Yeah, it can just help with the stakeholder engagement. Yeah. And that's not to say all of the projects are going down that route, but that certainly is one of the breakthrough elements of it. But most importantly, we've had some landmark projects over the last year particularly Georgia Department of Transportation. So the Georgia Department of Transportation really broke through in a new risk transfer, which enabled the private sector to meet the public sector exactly where it is and create what is the most high-profile, largest P3 that's ever been. And on the wake of that, you have Tennessee Department of Transportation, North Carolina is coming back to the market. You also have Pennsylvania DOT, even Washington State DOT is now looking to potentially use pilot projects for P3s. So sometimes it just takes these breakthrough projects to bring the market back together and set a template for the next wave to come.
That's encouraging. And on airports, now you know that's a topic close to my heart. 11 years of my career earlier spent at Heathrow Airport, and it's still a kind of fascination to me that more US airports are not yet under private sector management. But you mentioned the couple that are, JFK and LaGuardia, at least at terminals level. And I think those two examples are amongst the best that you could possibly imagine to be a sort of a test case for the transformation that private sector ownership of infrastructure can bring to the travelling public. What was your sense from the round table about the optimism about those test cases being so popular, so attractive that they might unlock more opportunity down the line?
Yeah. For our last P3 awards, which we run every year, I flew into one of the old JFK terminals, and I flew out of LaGuardia. And the difference between these two assets is just transformational. It really is. A gateway to a country is so important. The impression that a new terminal and a high quality terminal makes is just amazing. And so for P3s to have delivered that and to be delivering that right now certainly is one of the jewels in the crown of what P3 is able to do. And that is paying off. We're now seeing the US DOT has signposted that Dulles potentially will go through a P3 route. That's another huge terminal. And we're also seeing it filter down into the more regional levels as well. We've had a number of smaller but still significant regional airports look towards P3 as a way of delivering it. There were questions around the skill set perhaps in trying to make P3s work, because they are extremely complicated and do require a lot of effort to get to the point where they're investable. But certainly there's a lot of excitement. It's not just about terminals as well. The conversation has opened up into consolidated rent-a-car facilities, which can be multi-billion-dollar assets too. Also heat networks and some of the tech that's involved in the other elements of running an airport are really exciting avenues. We saw during COVID many airports look to P3s as a way of transitioning to cargo facility holding. And one of my favourite points from the roundtable was somebody was saying that decision makers, both in an airport and in a local community, can struggle with who should take the responsibility of opening up a new cold storage facility to open up a new market in their town. Should it be the airport? Should it be the city? And P3s have a way of potentially going, well, maybe I'll take that risk. I could deliver that. So you can see this positive feedback loop coming in. And there certainly is a lot of excitement about airports now. And not just airports, you see Penn Station as well is going down a P3 route, really exciting. There are these huge landmark projects being spearheaded by US DOT that are making waves, and I think P3 is really entering a new chapter on multiple fronts, certainly airports.
So, I think maybe just to sort of bring us towards a conclusion for this conversation and looking forward, the big legislative sort of opportunity this year is the surface transport reauthorisation. As you know, the current Act expires September this year. So there's a ever narrowing window for Congress to try and get something through. Where is that legislation currently, and what are the kind of highlights that you think lawmakers are focused on if they can get something through?
From what I'm hearing, the window is tight. There isn't a lot of room for drift to happen, but also that there is bipartisan support for another surface transportation bill, as you would expect. It usually does have bipartisan appeal. The contents of which, from my conversations, are expecting a maintenance of what the spending level is about now and not a further expansion. It's already at very high levels with IIJA's spending. And so the changes will be on an intricate level, perhaps changes to the ways that TIFIA work, and these systemic little blocks and permitting, for instance, that are needed to either to solidify some of the areas that have been shown to be really well, like TIFIA, or to help bring extra support for more areas. So I think that a lot does ride on the Act, but the big issues of TIFIA and PABs, which last March were the talk of the town and whether those key fundamental pillars of the P3 community were going to be there, that has died down. I think there's a lot of confidence that the administration is going to keep supporting this infrastructure sector and infrastructure as a whole.
Very good. Jonathan, thank you very much. That was fascinating. Thanks for sharing your expertise in this field, and I look forward to our conversations going forward in 2026.
My pleasure. Thank you so much.
So that's all for this episode of Talking Global Infrastructure. I'm John Phillips. Thank you very much to my guests, Darryl Murphy and Jonathan Davis, for sharing their valuable insights. You can find out much more about the latest market-led reports and insights for 2026 on our website at giia.net. You can also follow us on LinkedIn and subscribe to our monthly newsletter for the latest industry news and updates on our famous events program. If you haven't yet, make sure you subscribe or follow us on Spotify, Apple Podcasts, or wherever you stream for more episodes like this one. And finally, if you've got an idea for an episode or feedback to share with the team, give us a shout at communications@giia.net. We'll see you next time.